Many people believe wealth depends on having the right family, the right education, or the perfect business idea. In reality, most long-term wealth comes from repeating a few smart financial decisions over and over again. In this video, you will learn 5 rules to build wealth, no matter where you start. Don't skip rule 3 and 4. Rule number 1. Buy income-producing assets. Imagine 2 friends, Daniel and Chris, both receive an annual performance bonus from work. Daniel immediately uses the money to buy a luxury watch he has wanted for months. Chris likes the same watch, but instead decides to use the bonus differently. He purchases equipment that allows him to start a weekend pressure washing business. During the first few weekends, he earns enough to cover his equipment cost. Every customer after that becomes additional profit. One purchase creates excitement for a few weeks. The other creates income for years. Now imagine a graphic designer named Sarah. Every project she completes pays once, and then she starts over looking for another client. Instead of spending all her profits, she creates a collection of design templates that businesses can purchase online. She spends several weeks building the templates only once. Months later, people continue buying them while she sleeps, travels, or works on other projects. She no longer depends only on trading time for money because she owns something that continues producing income. Consider a local bakery owner. At the end of a successful year, the owner has enough cash to remodel the customer waiting area with expensive furniture and decorative lighting. Instead, the owner buys a commercial mixer that doubles production speed and allows the bakery to accept larger wholesale orders from nearby restaurants. Customers never compliment the mixer because they never see it. Yet it becomes the purchase that increases revenue every single week. The asset quietly earns money long after the excitement of buying it disappears. Think about someone interested in investing. Instead of purchasing the newest luxury vehicle with a large monthly payment, they choose to invest the same money into a diversified portfolio of productive businesses through low-cost index funds. Every quarter, those companies continue creating products, serving customers, generating profits, and increasing long-term value. While the car slowly loses value every year, the ownership in productive businesses has the potential to grow for decades. A small landscaping company provides another example. After saving profits for several months, the owner buys a second truck and another set of professional equipment instead of taking a luxury vacation. That decision makes it possible to serve 2 neighborhoods at the same time. Revenue increases without the owner working twice as many hours because the new equipment expands the company's earning capacity. The common pattern in every example is simple. Wealth grows faster when purchases generate future income instead of future expenses. Every time money buys something that continues producing cash, that asset begins helping finance the next opportunity. Over time, your assets become workers that never ask for a day off, never take vacations, and continue contributing to your financial future. Rule number 2. Increase earning power. Imagine 2 accountants who started working at the same company on the same day. Both earn the same salary, work similar hours, and receive similar annual reviews. After work, Michael goes home and watches television every evening. Emily spends 1 hour each night learning financial modeling, business valuation, and data analysis. She also improves her presentation skills because she knows technical knowledge alone does not always lead to promotions. About 1 year later, a manager asks both employees to prepare a financial report for a meeting with company executives. Michael creates a report that answers the question he was asked. Emily creates the same report but also includes charts, explains why profits changed, identifies risks, and recommends 3 practical solutions. She did not work harder because she stayed longer at the office. She became more valuable because she developed skills that solved bigger business problems. A few months later, a senior finance position opens. The company promotes Emily with a significant salary increase. Michael is disappointed because he has worked just as many years. The difference was not experience alone. Emily invested in skills that increased the value of every hour she worked. Now imagine a plumber who owns a small business. For years, he only accepts residential repair jobs. Business is steady, but income has reached a ceiling. Instead of simply working more hours, he earns certifications that allow him to service commercial buildings, restaurants, and office complexes. Each commercial contract pays several times more than a typical residential repair. His working day is almost the same length, but every hour is now worth much more because his expertise has become more valuable. Consider a freelance video editor. At first, he edits simple social media videos for small creators. Then he learns YouTube retention editing, storytelling, thumbnail strategy, and audience psychology. Instead of charging for editing alone, he begins helping clients increase views and revenue. Clients are no longer paying only for edited videos, they are paying for business results. His rates increase because the outcome he delivers has become more valuable. Think about a restaurant owner who notices customers constantly asking about online ordering and food delivery. Instead of ignoring those requests, she learns digital marketing, online ordering systems, and customer retention strategies. Sales increase without opening another location because she developed skills that improve the business itself. The lesson is straightforward. Wealth usually grows faster when you increase the value you create, not simply the number of hours you work. Every new skill that helps businesses earn more money, save more money, reduce risk, or improve efficiency increases your earning power. Higher income becomes much easier when you become difficult to replace. Rule number 3: convert raises into wealth. Imagine two coworkers, Alex and Ryan. Both receive a salary increase after several years with their company. Their paychecks increase by exactly the same amount. Alex immediately upgrades to a larger apartment, leases a newer vehicle, buys premium subscriptions, and starts eating at expensive restaurants more often. Within a few months, every extra dollar from the raise has already been committed to new monthly expenses. Although his income increased, his financial situation feels exactly the same. Ryan celebrates the raise too, but before spending anything, he updates his automatic investment plan. A fixed percentage of every larger paycheck now goes directly into a diversified investment account before it reaches his checking account. Because the investment happens automatically, he never has to decide each month whether he feels like investing. His daily life changes very little. He still enjoys vacations, dinners with friends, and hobbies, but he avoids increasing recurring expenses simply because his income increased. Every future raise follows the same process. A portion automatically purchases productive assets before lifestyle spending expands. Now imagine the owner of a small cleaning company. After winning several new commercial contracts, annual profits increase significantly. Many business owners celebrate by purchasing luxury office furniture, expensive company vehicles, or unnecessary renovations. Instead, she uses most of the additional profit to purchase another service vehicle, hire and train another cleaning crew, and invest in scheduling software that allows the business to handle more clients efficiently. 1 year later, the company earns even more revenue because the previous year's profits were converted into productive assets rather than temporary upgrades. Consider a software engineer who receives a large annual bonus. Rather than viewing the bonus as spending money, he treats it as an opportunity to purchase future income. Part of the money goes into long-term investments. Another portion helps launch a small online business that eventually generates additional monthly revenue. The bonus disappears from his bank account quickly, but it reappears later in the form of growing assets and new income streams. Think about a family that receives raises over several years. Their neighbors upgrade homes, replace vehicles frequently, and increase monthly spending every time income rises. This family chooses a different approach. They improve their lifestyle gradually while making sure every raise first strengthens their investments, retirement accounts, and financial security. Years later, they own assets that continue growing, while many of their neighbors are still dependent on every paycheck, despite earning similar incomes. The goal is not to avoid enjoying your success. The goal is making every raise improve your future before it improves your lifestyle. When income grows faster than expenses, wealth begins growing almost automatically. Rule number 4: protect what you've built. Imagine a small construction company that spends 8 years building a strong reputation. The owner finally has consistent cash flow, loyal customers, and several profitable contracts. Business looks excellent from the outside. Then, one of the company's largest clients delays payment for several months. At the same time, 2 pieces of heavy equipment require expensive repairs, and material costs suddenly increase. The company is still profitable on paper, but there is not enough cash available to pay employees and suppliers on time. Because the owner never built a cash reserve, he is forced to borrow money at high interest just to keep the business operating. Several years of hard work are suddenly placed at risk, not because the business failed to make money, but because it was not prepared for unexpected events. Now imagine another construction company in the same situation. The owner had gradually built a business emergency fund that could cover several months of operating expenses. When customer payments slow down, employees continue receiving paychecks, suppliers continue getting paid, and projects continue moving forward without panic. Customers never notice the financial pressure because the business had already prepared for difficult periods. Consider a family that spends years investing for retirement. Their investment portfolio grows steadily, but they never create a personal emergency fund. One unexpected medical expense and a temporary job loss force them to sell long-term investments during a market downturn. They lose future growth simply because they needed immediate cash. Another family follows a different approach. Before aggressively investing, they build several months of living expenses in a separate savings account. When unexpected expenses arrive, they pay the bills without touching their investments. Their long-term assets remain invested and continue growing while they solve the short-term problem. Think about a restaurant owner who relies on a single food supplier because the prices are slightly lower. One day, that supplier experiences delivery problems, leaving the restaurant without key ingredients during its busiest weekend. Sales decline immediately. Another restaurant owner works with multiple trusted suppliers. When one supplier cannot deliver, another steps in. Customers continue receiving the same service because the owner protected the business against a predictable risk. Now imagine a freelance consultant whose entire income comes from one client. Business feels stable until that client suddenly changes strategy and ends the contract. Overnight, nearly all income disappears. Another consultant gradually builds relationships with many smaller clients across different industries. Losing one client becomes disappointing, but not financially devastating because income is diversified. Protecting wealth is not only about making more money, it is about making sure one unexpected event cannot erase years of progress. Cash reserves, insurance, diversified income, reliable systems, and thoughtful planning may not feel exciting, but they quietly protect everything you have worked to build. Rule number 5: create money that earns more money. Imagine a young engineer named Kevin. Every month, he saves part of his paycheck. For several years, he proudly watches his savings account balance grow. It feels safe because the money is always available whenever he needs it. One day, he calculates how much that cash actually produced over the past several years. The answer surprises him. Most of the money simply sat there. It provided security, but it generated very little additional wealth. His coworker follows a different strategy. She also keeps an emergency fund, but every dollar beyond that is gradually invested into productive assets. Some money goes into low-cost index funds. Some helps purchase shares of businesses that regularly pay dividends. Later, she invests in a small rental property with positive cash flow. Several years pass. The difference between the two strategies becomes obvious. Kevin still depends almost entirely on the income from his job. His coworker's investments now produce dividends, rental income, and long-term growth. Those earnings are reinvested to purchase even more assets. The assets begin buying additional assets without requiring extra working hours. Now imagine the owner of a local coffee shop. Business performs well, and every year there is extra profit left over. Instead of withdrawing all the profit for personal spending, the owner opens a second location in another neighborhood. The first store helps finance the second. Later, both stores generate enough profit to support a third location. The original investment begins creating opportunities that would not have been possible from salary alone. Existing money starts producing additional money. Consider a photographer who creates an online course teaching beginners how to improve their photography skills. The course requires months of planning, filming, and editing. After launching, students continue enrolling throughout the year. Revenue from those sales is used to create another course and improve marketing. Each completed project becomes an asset that helps fund the next one. Instead of starting from zero every year, the business grows from the income generated by previous work. Think about an investor who receives quarterly dividends. Rather than spending every payment, the dividends automatically purchase additional shares. Those new shares later generate even larger dividend payments. Over many years, the cycle becomes increasingly powerful because every dollar earned is helping produce the next dollar. This is one of the biggest differences between earning income and building wealth. Income usually depends on your time. Wealth grows when the money you already own begins producing even more money. The longer that cycle continues, the less dependent you become on working for every dollar you earn. If you found this video helpful, please like, subscribe, and share it with someone building their future.